think it's partly, as the previous speaker said, you get a bit of fatigue. Clearly, the purchasing from the asset purchases, not of stocks, but of assets in general from the Fed, have helped. I saw an academic piece recently from the University of Technology in Sydney, which suggested that maybe around a third of the rally in the S&P 500 was down to Fed purchases based on historical statistical analysis. So there gets a point when that is in the market, and when the Fed starts to look at, well, do we really carry on with all of this? And things like, I don't know, the Fed minutes coming out today. Who knows? At some stage, maybe not today, but at some point in the future, those members of the FOMC who are concerned about the implications for financial instability of what the Fed is doing, maybe they start to gain the upper hand, and then the market starts to integrate the fact that these purchases are not going to go on forever. Short of that, obviously, just continued economic weakness coming from repeated lockdowns, I guess, is the obvious answer.
Paul, can I go back a stage? I'm wondering if you're inadvertently falling into the trap that many of our viewers and commentators, even on this channel, for CNBC make, and is looking at a few stocks and a couple of sectors and saying, we've gone away to the races, I'm really worried about the rest of the market. Because when I look down at asset class after asset class, index after index, sector after sector, I see us nowhere near the record levels that we're seeing on the S&P and the Nasdaq as well. I've got a list here in front of me of load of global bourses, most of them, and their percentage away from their record closing high. Were they 30, 20, 15, massively far away from those as well. So whilst I appreciate certain parts of the market have gone away to the races, and it's obviously led by those growth stocks, the rest of the market is nowhere near worrying levels, is it?
No, I think that's a good point, and you could make the argument that the stocks that have been driving this were the stocks that are naturally going to favour from these economic circumstances. You take a company like Amazon, it was almost made for a pandemic, given the business mix of internet shopping, home delivery, cloud services, and home entertainment. So I think there is some justification in the idea that what has been driving the market are stocks that are naturally benefiting from it. But frankly, when you look at the second quarter earnings season, with one or two exceptions, the numbers that were coming through, say on the tech side, I don't think in any way justify what has been happening in the tech sector as a whole. And if you do look across asset groups as an entirety, you take a look at something like credit, high yield credit. Spreads never got anywhere near where they have done during certainly the financial crisis, and during what one might have or didn't reach anything like what I would have expected during a recession as deep as we have seen this time around. So I think that asset values in general have been propped up by central banks, and they have enabled markets to look across that chasm of a deep economic recession and look through to the other side in ways that we haven't seen in previous recessions.